Let's also bring on board Jim O'Neill, former chairman of Goldman Sachs Asset Management, to talk about global markets. Jim, hi, morning. The recent data has raised concern over whether or not the Fed will go ahead with tapering as per the schedule. You think it would, but hasn't the Fed time and again stated that their decision would be data dependent?
Well, I think if a lot of the other data were showing the same kind of negative surprise as the payrolls, that would definitely be the case. They would pause. But the other data that we've seen raises the usual suspicions as to whether that particular month was a bit of a rogue figure. Having spent as much time as I have in my life thinking about payroll numbers, you know, I know people whose companies have gone bust trying to bet on payroll numbers that by the time they were revised a few months later were exactly what they initially thought. So I can't imagine the Fed would want to change the whole view just on that payroll number.
Jim, so is it too early to conclude that the US is back on track on earnings and GDP growth, because nobody really knows how strong the economy is without the QE?
Well, unfortunately, there's no answer to that until we go through time. You know, people never really know how strong any economy is, even though they might claim they do. Particularly because of what's happened in 08, 09. There is this feeling still, 5 years more on now, that there's all this uncertainty, but the reality is uncertainty is a fact of life. It's just that we now know things are more uncertain. But we just have to see how the data keeps on unfolding. I would say, based on the sort of things I've learned to follow, that it looks like the US is showing more and more signs of doing better. One of the things that surprises me is there isn't more recognition of how the US is emerging post-crisis as a different place than before it. I spent a lot of my life looking at trade data and things related to international markets, of course, and US current account deficit's now running at something like 2% of GDP. That's 1/3 of what it was before the crisis. So the US is adjusting to a much more competitive state than it was before the crisis. So I think there's quite a lot of encouraging signs, to be honest with you, about the US.
The dollar, Jim, has not been as strong as expected post the tapering announcement. Why is that, according to you?
I'm not overly surprised. I mean, you know, again, having wasted far too much of my professional life trying to guess which way the dollar's going, one of the few constants is that the dollar doesn't like to go up much, and at the core of it is because the US policymakers don't want it to go up much. Even though there's been a start to tapering, the Fed's made it pretty clear, as we just touched on, that it's highly data dependent, and the Fed's not rushing to any kind of severe tightening. So whilst it's become the fashion in the markets to, from what I can see, very much like the dollar and to prefer it, you know, it's not a straight line for the dollar to rise. The last thing the US authorities want is a big rise of the dollar. So I'm not overly surprised, and as it relates to the broader question of the major currencies, I'm glad I'm not as involved in it as I used to be, because I don't think it's so easy to find one that looks so attractive relative to another. Particularly now the yen and the Australian dollar have both fallen so much. This time a year ago, being bearish on those two things was pretty obvious, but today I wouldn't want to take a big view on any of them, with the possible exception of the Swiss franc, which looks highly unattractive to me from a valuation perspective.
Some believe that countries like US and UK along with Germany will continue to be winner as recovery takes hold, and putting money into smaller groups is not really the best of the strategy.
Not really. I think it was a stronger point 3 years ago when the US market was so cheap, but I think it's amusing to see this highly fashionable thing you've just summarised. Ultimately, the Western economies, US included, can't sustain strong growth unless they're going to export to all these new emerging countries. So, you know, if it is the end of the so-called emerging market story, then actually it means for a lot of developed countries, particularly the likes of the UK and crisis-challenged Europe, that would be a disaster, because we're relying on significant export growth going forward. Let me add to that, going back to what I touched on before, it kind of all depends on valuations. Going into the crisis, or the build-up to it in 08, China and India were trading on a forward PE of double the US. And of course, people dreamt up reasons why they should invest in China and India directly and never in the US again. Today, we've almost got the exact reverse of that. And all that tells me there's a strong likelihood in the next few years that China and India are going to outperform the US again. So I don't know quite whether it starts tomorrow, but you know, these things do have a habit of sort of mean reverting. One third point at half time. You know, I find it hilarious how people are focusing on this sort of supposed worry about China. Even though China's slowed last year to 7.7, China's now an economy of 9.2 trillion. It's twice the size of Japan. It's adding $1 trillion to global GDP every year. And the new China, particularly the growth of their consumer and companies related to that, they have got to be the best investments in the world. Whether they are ones in China that we don't know the names of yet, or other companies around the world, is a much trickier call. Well, that kind of depends on valuations, I would say.
So, Jim, I mean, you're looking at India very closely as well, given the election event. Do you think it's going to be very interesting for India in 2014, post the state elections and the rise of the third party, that's, you know, Aam Aadmi Party? Have your political views changed?
Well, it's a big year for India, big year. You know, India needs somehow to borrow a bit of the Chinese leadership's determination. All the problems that people talk about India, particularly the cyclical ones, are quite easily solvable. If we had leadership in India that managed to not just introduce but embrace foreign direct investment, the biggest problem they'd have would be stopping the Indian rupee rising. The Indian current account is not really a big problem, or certainly not the scale I read people talking about it. The problem is leadership, and that's the issue that I'll be looking for out of the election. This third party appears to have made it quite a bit trickier, but I would imagine when you get closer to the general election, they might not seem so attractive, I'm guessing, as they have done in local elections recently. But we'll see. It's a really important event for India, which, of course, in some other places like Indonesia and Brazil, you've got really big elections there coming up in the next year too, or next few months.
Jim, having said that, inflation seems to be easing in India, and Reserve Bank of India did not move in December. Do you think there is rationale for a possible rate cut by RBI in their next policy meeting?
Well, I'd imagine they're going to be, you know, I don't follow this day to day or week to week, but I would imagine they're going to be cautious about cutting rates too prematurely, seeing this sort of mini vicious circle that India got itself into late autumn, early December. They don't want to do that and then just have to start raising them again 5 minutes later. So I suspect they'll be a little bit cautious early on, but it looks to me, on the bold assumption that you have got stronger leadership after the election, that the Indian story could quite easily turn very positive again very quickly, and as part of that would be an environment of declining inflation and declining interest rates.
Jim, really appreciate you taking the time out and speaking with us today.